weekly webinar, 25th of September, 2024. I don't know if you listened to the podcast, but every time we hit the 25th of a month, I am reminded of Christmas. We're 3 months off. And I keep saying this, every time we have to sell off before Christmas. September is quite a bad month. It's been a bad month. It's not been good. September generally is a bad month for stocks. And then we get a sell-off. October starts to get better. November, December, generally very good months. So maybe we're getting towards that. And maybe after the budget, I do think the budget now is starting to weigh on the AIM All-Share Index. There's this worry about the tax incentive being removed for AIM stocks and all that stuff. So, and this capital gains tax. There's only 3 areas they can tax you on pretty much because they box themselves into a corner, Labour. And that's CGT, capital gains, of course. So get everything in your ISA, stocks and shares. And there's inheritance and pensioners. So I do think it's weighing down the markets. In fact, I was just looking at the AIM All-Share just now. And look at that. There we are, September, that was. September the 6th, 3 years ago, 2021. And look where we are. It's been a long, horrible bear market, still in the bear market. 803 is a bull market. But we are, look at this, rolling down. It rallied nicely, didn't hold these levels. And then it's down now below the 200-day moving average. And you've got the death cross happening. That is when the 50-day moving average crosses down over. We did have this, golden cross happened back in Feb, and it did play out, and now it's coming back down. So it's not looking very good. It's a tricky old month there, but hopefully some big things coming up, isn't there? There's the budget, which is just before Halloween, which is very appropriate. Hopefully it won't be as bad as they say. I think they are sort of managing the expectations a bit, and I don't think it'll be as bad as everyone says. And then we got, a few days after that, we have the Bank of England coming out, which they're saying is, odds on producing rates again. So, and as long as we don't get a World War III happening, which is increasingly, worrying, isn't it? I mean, what's happening in the Middle East and in Russia, it's really scary. And the fact that the oil isn't rallying, that's worrying. I mean, normally oil starts to rally a bit. I mean, that's China, of course. China's no demand from China. Anyway, sorry, is there any? Let's say if you want to say anything, let me know. Could do with Beeks rallying. My stop loss almost kicked in today. I topped on Beeks. Yeah, do you know what? I don't know if you saw what happened to me. And in fact, David on Discord just contacted me saying, be careful, market makers can see your stops. And my stops on Synectics were taken out. And I saw the stock drop by 9%. I thought, what's going on there? It was at 224. It was, I think the price was, and I had my stop loss 220. So I went to remove it down, and all of a sudden I had no Synectics shares. I put it in the blog, by the way. David's iPhone trying to talk to me. Yeah, and so I know they can see stops, and if you have a significant amount and it's a good company, sometimes they'll raid them. I've heard of this before. It's never happened to me. So my stop loss got taken out at 220. The share price is showing 224. And I put the chart on the screen, the screenshot on the blog showing it didn't get down to 220, and yet my shares are sold at 220, which is very annoying. But I do believe Synectics is a great thing. So I may even take my stops off on Beeks. I mean, it's not cheap, but I think it's an exceptional business. And so maybe I'll just go with it. Who cares? So there we are. Synectics hit 214 after I took mine out. Didn't before. They dipped down and take my stuff out. Literally, I went to the Barclays stockbrokers. I had no Synectics shares. I looked at the chart, and it didn't get below 222, I think. And I was taking out all of a sudden it went over 210. So the low of the day was 210, but and that was 15% down. It ended up 5% down, and then started rallying again. So, what? That's so annoying. Anyway, so I made even mess around. I may even pull my stops out because there's a trading update, or should be the full year results coming out early October for Beeks. And so I'm gonna watch. Anyway, listen, let's get on with them. Just talking. Here we are. Topics tonight. My holdings. Ooh, I've got many. Today, by the way, I raised my stop this morning Because of AIM, I think, largely, and on Premier Miton, it got taken out at 64 pence. I've been reading about AIM. In fact, it's a good article. I could share it with you actually about AIM, how little money has been raised this year. It's down 30%, and it's down like 80% from 2 years ago, down 30% year on year, and it's down 80%, and it's not showing any signs of thawing. So, companies who are not profitable are having real problems raising money. I see some really horrendous fundraisers at discounts, and that's why it's a good thing to, just focus on. You see a lot of people on Twitter and social media saying AIM's knackered. The market makers and the discounted fundraisers. Wow, don't bother investing in companies that need to raise money. If you need to invest in companies who need to raise money, wait until they've done it, because it's a very hard market and it'll be a huge discount generally. So yeah, it's the reason why AIM is there is to raise money capital for growing companies. Now, once they're profitable, they don't need that. So that's the area to focus on, I believe. And I don't think it's going to get any easier for a while. Anyway, we'll do watch this or ignore a couple of companies with news out. But also, sorry, I meant to put in the update. I'm very excited about it, but I'll talk you through that in a bit. So my holdings, it's reducing. I did do a little top up in time. I think time is ridiculous. We went up 8% yesterday, and then it came back today. Today was a horrible market though, and the volume was up quite a bit today. If you look at the average daily volume on time, it was but cracking results. Look at that. So yesterday, on the eve of results, it rose up, and today, where's time? Average daily volume today 900,000, when the average daily volume is 160. So I did watch the investor meet, and I think the CFO said there's retail. And I thought, I don't know if that's retail actually. 900,000 at 50 pence. What's that? 450 grand. I don't think that's retail, unless there's a big player in there just selling. Who knows? I think if we have a positive day tomorrow, I think that'll go back up. That's a nice little pop. That I think that'll go back up. Anyway, we'll look at those in a bit. Okay. I did top up on that. And I'm quite confident in Ramsden's. And I don't mind top. I know my rule is literally if I'm in profit. So basically, if you look at my portfolio, if you're new to the webinar, what I'm trying to do is literally leverage towards winners. Keep your losers small, whether you want to use a stop loss or just keep them small at the start doesn't matter. But as long as you keep them small at the start, don't go massive on them. Don't believe the story before it plays out. Then if it goes wrong, your loss will be small. So that's what I intend to do. So with Ramsden's, I'm quite confident in them. I just think they are undervalued. I think they're doing very well, especially the gold price up. And I think they'll do very well. So I'm 11%, 3% up. Normally I want to be up more than that if I've got that position, but I'm up anyway. But I don't care if it comes down a loss. So yes. Sorry, is there anything else? I'm sure Time news was leaky yesterday. Yeah, OMG, had big drops on poor results. Yeah. Sorry, I missed. Why did you sell your bonds? So I said before, I went into bonds, and I think I played it a bit late on the bonds front. I think they're a little bit priced in. I think they'll do well, but I don't have as much confidence in bonds as I do in stocks. I know about equities a lot more than bonds, and I thought I'll just sell it. I was like, I think about 1.5% down, but I got paid pretty much the yield or the interest I paid or dividends reinvested probably took me about 1% down, and I just sold out those. I didn't want them anymore. Have you seen the Vanguard Life Strategy, which have 20% bonds in it anyway, and the ETF? Now they are largely, even the Vanguard Life Strategy, which is a very good fund. If you are taking one of those out in the UK, they're more biased towards UK stocks. So I'm overweight in UK stocks because these are FTSE 350 highest paying dividend stocks. But I will be putting I've said it before, but this is hopefully my retirement fund. I'll putting a regular amount into. And I was just thinking, look at this, right? Any dips on these should be bought massively. Where is it? Life Strategy. Yeah. Look at that. Something like that. When you see some of that hitting, I put alerts on this. Anytime an RSI hits like oversold on funds, not so much stocks, because if a stock does that, it could be a specific problem with the company. But with funds, when this fund holds I think it's something like it's close to it's over 5,000 companies and bonds, And when you get a general market sell-off like that in a fund, then and it drops by what, 9%, you should pile in. I mean, look at that fund there. I mean, it is largely, UK American. It's around the world, but yeah, you can really go big on funds on a well-diversified fund if they have a big market sell-off like that. So that's what I'm waiting for. I'm not going to go too big on it. And I believe if you look at this, you see, throughout the year, you see 2 or 3 dips a year, pretty much, in the markets. And you think that they are buy the dip opportunities in funds. Absolutely, they are. And so anyway, so I'm just more of I prefer, I prefer sort of and a lot of that is a little bit worrying because some of that is the Magnificent Seven play. They'll roll over, but nevertheless, they still got those companies have got great earnings. They may be a bit overvalued, but they're not like people say, oh, it's a dot-com bubble. No, it's not. Because the dot-com bubble was based on companies that had no profits, some of them no revenues, and valued in the billions, which is ridiculous. But those, the Mag 7, I mean, they are highly valued, but they do have excellent, they churn out some cash, a heck of a lot of cash. So anyway, the Vanguard Life strategy has those, American stocks in them, and also British stocks. Yeah, okay. So that's, that shows, the size and positioning. So the small ones, the red, and keeping small, hopefully. So 5 companies in profit, 35% their portfolio weighting, 4 in loss, 7.7. Total company risk there. So there we are. So, I've now got 46% cash. I do think, I don't know what I think. I think we'll have one of those sell-off, days that'll happen, and then it'll be a buying opportunity for companies I hold. But I keep looking around, right? And this week, I don't know if you read my blog. The hardest thing in investing is discipline, by far. Nothing more than that. If you have discipline, you cracked it. Okay, to stick to your rules. But because we're humans, we tend to break the rules. But it's not a bad thing. You shouldn't beat yourself up too bad about it, as long as you don't make big mistakes and go too big on them. Because when you do break the rules, you realize, why did I do that? I know I shouldn't have done that. And it sort of reinforces your rules then. And so you tend to then go a bit overly, stick to your rules a bit too much. And then you get a bit bored and then you mess around and go off piste skiing. And then you break your leg and think, oh, I should have stayed on piste. So it's not a bad thing. So what I've done here is literally, the companies I got here that I really like is Beeks, Time, Ramsden's. I think good will come very good in the end, and I think ADF could do well. But Beeks, Ramsden's, Time, I really like them. In fact pretty couth, but I'm happy to go bigger on those rather than seek other investments. At the right time. And Synectic is another one which has got stopped out. Stopped out first time 10% profit. Stopped out second time 19% profit, which is annoying. But I'm happy to go bigger on stocks I really feel comfortable with than just search around for new stocks that I think, because Oxford Metrics, right? I wasn't impressed. I mean, in fact, I talked to Jim on Discord. I said, he asked me about them. I said, yeah, they're oversold, and they bounce when they're oversold, tend to. They've got about 50 million in cash, but I'm not impressed with the interim results. They don't have growth. Their value's all right, but they don't have growth. Now, looking at small cap companies, growth is essential. They don't have that. So why did I jump into them? Just because I saw a bit bored. I thought, okay. And then they came up with a trade update, and it was bad. And so it's like, well, luckily, I only had 2% in them, and I lost 20% at 2%. So it's not a big deal. But sometimes you think, okay, it's good to make silly mistakes at that because then it reinforces your rules. And there we are. So okay. So if you miss it, I bought U today. Interim results dividend was strong. Yeah, U's been coming off a bit, hasn't it? I've had some alerts on it. U Group. I got a Vanguard Life Strategy 100. Do you know if you can convert to 80%, or do they need to buy hardware-based, not recurring revenue? Yeah. Do you know what, Mick? I don't know if you've ever looked at this, but Vanguard do retirement funds, which is quite good. Because what they do is, the closer you get to retirement, the more they put your money in bonds. So they start off, I think, it's like 80% equities and things, and they automatically do it. So every year or so, they'll edge up. So every 5 years, I think they'll They go 10% more overweight in bonds and 10% underweight in stocks. But yeah, I wouldn't mind. I mean, 20% in bonds is not a huge thing. I just want to give it a try. So I have a few bonds in there. But 100% equity is fine. You talk about 7,000 companies. It's one of the best, low cost sort of diversified funds out there. It's fine. It's not a lot in it, really. I don't know why. I don't know why I went for 80%. It's just that a bit of variety. But yes, but if you don't want to mess around, with knowing how many bonds, go for one of the retirement funds. So you set your date of retirement. It's on their website. And so if you're retiring, let's say in 20 years, for example, what's that? What are we now? 2025, and say, yeah, 2045. So you do 5 years after that, 2050 retirement fund. And it starts off with, and it'll automatically adjust towards bonds the closer you get to retirement. So that's supposed to be safer. But saying that, we've been through, it probably won't happen again now, though. We have been through a bond meltdown in the last 3, 4 years. So people who are retiring recently probably took a bit of a knock on that. Anyway, sorry, let's get into this because I'm quite excited about this. So that's that update. Now I'm going to read you my blog if you haven't read it, right? Last week, I did say that I wanted to. The reason why I set up the MicroCap League is I want to find the best businesses sub 100 million market cap. And it turns out, what is a good business? And I believe a good business is something that's growing. You get top line growth because there's lots of demand for their product. And that demand is increasing because they've probably got one of the best products on the market or services on the market. That shows a very good business. And not only that, they're decent value because their profits are going up, all that stuff. And so how can how do I find this? And so that's the reason why I set the MicroCap League. We realize good businesses also, they have sustaining, revenue and profits. And last week, I was thinking, right, what I want to do ideally is have this list of companies, no more than 50, because there aren't, honestly, be surprised. I now go through in the podcast every day results from AIM companies. You'd be surprised, maybe you wouldn't, you'd be surprised how many crap or average companies there are out there. And you think, all you have to do is pick better than average companies that are good value. And if you stick to that, you should do well. And then I thought, right, what I'm going to do is do this, create the MicroCap League, filter these companies on 20 different metrics, and then all you need to do is buy the top 10. Now, I've looked at the top 10 and it's smashed. I've made comparisons. I've done a couple of videos on it of the top 10 versus AIM. And it's smashed AIM. AIM, of course, there's a lot of crap in there. Oil and gas stocks, resource stocks, biotech stocks. They're never going to earn any money. So that's not a hard comparator. But nevertheless, it smashed them completely. And then I thought, right, I'm going to start investing in the top 10 because it's okay, back checking it with spreadsheets. So let's do it for real. So I've just put a grand in 10 companies, a grand each. And then I realized, hang on, Billington's at the top of the MicroCap League. And I didn't understand this because, and I'll show you why. I thought that shouldn't be. And in fact, I think it was Rob last week said, we had a look at Billington, didn't we? And he said, maybe we get rid of that. And so there's Billington now. Now it's been updated. I'll show you why. Why shouldn't it be at the top of MicroCap League? Well, I'll explain why. Let me just pump this up. Because they had a cracking year last year, without doubt. Okay? Without doubt, had a cracking year last year. They've also got a very healthy, look at this, pretty much all in the green. Okay? Now, these scores are based off last year's results. Now, if they continue those kind of results, that'd be good. But I was looking forward at the forecast, thinking they're not going to continue those results. And the broker forecast had 20% upside. Okay. But I don't trust broker targets. And I tell you for why. First and foremost, number one, they work for the company, right? So they're going to be a bit flattering about the company. I mean, 20% not a lot, so maybe they're quite accurate on that. But I don't trust the broker forecast because they use many different metrics. It can be price to sales, it can be EBITDA, it can be net profit, it can be discounted cash flow, and then the multiples they put on that can be quite subjective. They'll say, oh, this is their sector peers, but their sector peers may have better margins, they may be more mature, they may be slightly different. You can't compare like for like, really. So I didn't really trust. It wasn't uniform, the way they give their targets. So that doesn't show the potential. And that's what potential last time was marked on. Potential was based on the broker's target price. Okay. And I didn't really trust it. So only 13 points, 1-3, out of 100 points came from potential. And I thought, really, it should be more than that. but I've got to find a way of doing it because the share price is not only what a company has done, it's also a lot about what it's going to do. Shares we look forward all the time, and so we have to try and capture what's going to happen in the future. Now, trying to do that is hard because no one knows the future, but you'd be surprised how accurate the forecasts are because companies do trading updates and then they release their results 3 months after the dates. So this is what I've done now. I've taken a couple of points because the highest scoring points were the growth and value for the last full set of results. But you realize, yeah, that's happened. What's going to happen? Now, look at this. This is Billington. They were number one last week. It's not right because this is the 31st of 12th, 2023. Okay, so that's the last year just gone. Look at the results. Cracking. Absolutely cracking. And they should be scored highly on that. And then they came out with half-year results. Look at that. The colors completely changed. Now, these will be baked into the next set of these results. Okay? So even though the value is fine, the growth is not, and that's the most important thing, you're already getting the sense that within the half year now, they probably would have done a trading update the half year. So, and I'll show you this on a time scale now. But so you sort of, you can sort of see that they're not going to do as well as next year. And you scroll down, right? Look at their forecasts. These are taken from brokers, okay? The broker things. Now, you can be roughly assured that 2024 is quite accurate now because we are into September. There's only 3 months left. So, the update they just did is quite accurate. So even though we're 3 months away from the end of the year, and understand they don't report full year results until 3 to 6 months afterwards. In fact, they can take up to 6 months to come out. That we pretty much know with a high level of probability that they're going to do this. So top line is going to dip by 6%. Importantly, look at this, profit's going to drop by 30% on Billington. So how can they be top of the MicroCap League if we're looking forward? They can't. Simple as that. So I've changed potential. And now what it's based on is the revenue growth. Because regardless of what the target, the broker target gives, it's going to be based on when a company comes out and their revenue's gone down and their profit's gone down, that's what the market reacts to. It doesn't react to the target price of the broker. It say, well, the broker's given it like a target price 20% higher than this. Doesn't matter. When they release results that's not as good as last year, it's going to go down. Because that's what most people look at, right? So these are now based on, so if you look at our forecasts, these are now based on top line growth, okay, pre-tax profit growth and value. So they're based on, are their sales growing? Are their profit, is it staying where it is or growing? So if the sales is growing and they're keeping their margins, the profit will grow as well. These are real facts, and these are quite accurate because, like I said, we'll have known this by H1 pretty much. Most companies, if they have a bad first half, they're not going to blow it out in the second half generally. And also, it's going to be based on the value as well. So to get top marks on these three here, okay, and now I've increased the weighting of potential now, and it's now to 23 points out of a possible 100. It's 25 points for growth, I think 20 points for value. Those are the three most important metrics, and momentum. 20 points momentum, okay? So if you're looking at a company, the most important metrics are growth, value, momentum, and then potential. So think, okay, so it's dipped a little bit, so it's not going to do so well. So that's why I was pleased to see when the guys, developers updated this, they dropped from number 1 to now number 9. So maybe I would start investing in them, but the momentum is going down a bit. So there we are. So, and in fact, let's look at this. So honestly, it's on the blog. How accurate are forecasts, right? The figures are released by the company. They're not quite accurate. They're very accurate. And they will do trading updates like a month before their first, half year, and maybe a month or so before their full year. And then, of course, the results aren't released until months after that. But so this is quite complex, but try and get this into your head. So let's say this is 2024, okay? And this company's reporting year is from the 1st of January to the 31st of December. Right? Now, their half year's here, and they'll probably do a trading update, say a month before, so that you know pretty much how well their first half is going a month, maybe a couple of weeks before their half year is up. So your accuracy there of knowing what they're going to be doing for the full year is close to 50%. Considering you've got like 6-7 months left of the year, you'll know straight away, and the brokers who are talking to the company will be putting figures into the market. I will update the broker forecasts, and you'll see straight away, is this company going to grow next year? And then you get H1 results come out, and they'll probably do outlook then as well. And so there'll be another broker note coming out. They'll be updating. So that will be even more accurate. So 7%, because they know what the rest of the year, unless this company has like a very strong H2, or it's a seasonal thing. But even that, you can look back and see, the brokers will allow for that. They'll say this company generally does 10-20% more in the second half, and they'll allow for that. So it's fine. So what I'm saying is, by the time you get to like the full year trading update, which is a month, maybe a couple of weeks before the end of the year, you've got 100% accuracy of what they're going to be doing this year, and they won't release these results then between March and June next year. And by then, you pretty much, they'll have an outlook on this year. So you can be ahead by several months on forecasts. So they're more accurate than I think. Just the broker saying, we give this a multiple of 20, or because I've seen some broker targets, and I said, how do they get to that? I've seen like loss-making companies not growing very much, and they've got like 200% upside. I thought, no, I don't understand that. And let's be honest, the market reacts to revenue and profits. They don't react to broker targets. So it's good to know where the broker targets are, Anyway, so now I have more confidence in literally investing in the top 10 companies, because I know not only have they had a good year just gone, but it's highly likely the next year coming up, unless they have some kind of big contract that drops out somewhere. By the way, I haven't put the stars yet on the things here. And in fact, look at this. And I've said this many times, even before this came out, right? Even before this came out, what has been number one, number two in the MicroCap League? Good companies. Time has rallied recently. Where's time gone? It's down there. That's because it's rallied, okay? And next year's revenue, and I'll show you Synetics, for example. No, it's number one. It's been number one for a while. And and whether you believe it or not, it's working. The MicroCap League is working. And this tweak, I mean, look at that. Synetics has always been up there. I mean, I don't know when I bought this, maybe down here somewhere, but I've been banging on about this, saying it's number one in the MicroCap League for ages. And yet it's back there now, because it had a little dip. It's come down. And I'll buy back into this, because but what I do want to do is leave a month before sorry. So if we scroll down here, this is last year's scores, all good. The value now is a little bit questionable. It's not questionable, it's amber. It's not red or anything, so it's not worried. So we know that like top line is 20% or 19 point something it'll be, because that's an amber. But then if you scroll forward, okay, look at that. So the forecast, the revenue is going to be growing a little bit. The forecast profitable growth is going to be about 33%. And the PE is only 15. That's good. And that's why it scored 15 out of 23. That's why it keeps it up there. Every other metric is good. So it's worth obviously scrolling down. And look at these. So I'm looking at these growth figures here. And they're looking at 41% for pre-tax profit the year after. So top line is growing at 13. That says to me the margins. I mean, of course, the more these forecasts go out, the less accurate you can be. Remember, they're like the weather forecasts. But you can pretty much say, we know 2024 now, they're mostly way through this year. So we know they're going to sort of deliver these kind of figures. And if they do, then it's not overvalued. It's going well. So their revenue's going up nicely, but the profit before tax has got even more. So I do have a lot of confidence in these kind of in these new figures now, just adjusting that potential figure. Journey again, I looked at Journey. I think, right, this is a good, I was into this, and it tripped me out. Again, this is last year. So these are the half-year results. Okay, all good. Yeah, all good stuff. Look at potential here. Okay, revenue growth isn't going to be that impressive, but next year's profit before tax growth, 27% again. And the PE is 11 for next year. That means there's, good growth on profits and the value is decent. So when you're looking at that, pay attention to the next year. So for companies towards the top end, pay attention to next year because, we all know it's not about what a company has done. It is about that. I mean, that starts it off. Once you start getting good earnings and good revenue, that starts the momentum going. But then if you can continue doing that, then, then of course the share price should continue. And I keep saying sometimes, it's odd, isn't it? Buy into strength and avoid weakness. And I don't know why I even got into OMG. I mean, they are like now they are at their net asset value OMG, but it's odd. It's like in the book, there's a whole chapter about buying strength rather than weakness because companies that are doing well tend to have a good product. They tend to have good management that are, selling that very well. It's going right for them. And that takes a while to change. And likewise, with the companies that had a profit warning, something's gone wrong. And it takes a while for that to change. So it's not just by the, by a falling knife, because you can get cut. It takes months and months and months for a company to sort of start turning around again and then getting growth back up again. So you're better off buying into strength and weakness. If you see a very good business you like that has a profit warning, yeah, put it on a watch list and wait till it starts improving again. But it's not overnight. So many people lose money by, catching a falling knife trades like I did with OMG. Anyway, does that sort of make sense? I'm really excited. I don't think there's any system like this. And I've thought about this on dog walks and so many times. And sometimes you go there, and it did it last week when I was going through the companies and Billington come up there. I thought, the forecast's not very good. Why is it number one? And now it sort of makes more sense. And the thing is, this is the thing. How many private investors out there, right? Just banging on like about Billington or something or whatever, actually don't know what the forecasts are. You do now. You know full well that's they're not going to have a good year next year compared to last year. Last year was a blowout year. I mean, if you look at what they did last year, it was phenomenal. They went from 86 million to 132 million. I mean, it's not going to be a write-off. It's going down to 125, which is still from the last year. It's good. But when you're comparing like for like, which what happens? How many private investors know now that they're not going to do as well as last year? In fact, their forecast for profit had dropped by 30%. There's no way the share price will rally on that. No way. I don't know, in this market, it's very odd, unless it falls off a cliff beforehand. But so it's an extra layer of protection, knowing, what's happening next year and having confidence in next year's figures a little bit, unless they come up with some profit warning. But so you're ahead of the curve here. If you look at these figures, you're ahead of the curve. You're ahead of most private investors. And another one like this is I do like what is it? Interseed. I mean, the rally's been strong on that. In fact, they came up with news, haven't they? And I think there's a couple of people talk about this and they bang on about it. And I think, yeah, but if you look at the valuation here, so the valuation is not that good on even on these blowout figures here. Okay, on these blowout figures, the valuation is not that good. It's a bit rich. The PE of 19. In fact, it was 38 last year. That's not too bad there. But look at that. Look at the forecasts. These are the broker forecasts. Now, this is a broker paid by them, and they know what's in the market. They're going to drop by 19%, and forecast profit before tax is going to drop by 47%. Is that going to continue to rally when they release, unless they have a big update? And this is why I want to get the league down to about 50 companies that are good quality companies, because I can keep an eye on every broker note that comes out, and I can update these forecasts. So yeah, so pay attention to the potential, because like I say, shares are as much about what you do or what you're going to do as what you have done. So yeah, just pay attention to them, and because now full well these companies at the top here, they're looking like they're going to have a good year next year. Be careful with anything in the red, of course, because they've got news coming out. In fact, when's Indices out? Indices the 23rd of the 9th. No, that's wrong, isn't it? So Do they have a IGP, isn't it? Is it IGP? When did they say notice of results coming out? I was going to say, I'll have to update that then. I'll check that. Hang on. IGP. It's got to be soon. 61 days they've got. I'll check that out. But anyway, so that's why I want to keep it to a short amount because we can really be over companies that are decent and have lots of detail on them and news on them. Anyway, sorry. I'm banging on about rubbish. Indices, they've already had the results. No, they've had the results for, didn't they have the results for, that was half year, wasn't it? Or what was it? No, that was in June, yes. That was for December. But yeah, I look at, hang on. I got those for June. Am I there? Yeah. Oh, yeah. Okay, for the half year. So they're looking at, so next year they're looking at the drop in the forecast. That's where they're updated from. By the way, if you want to see, what the brokers are, let me just check the broker prices on this. Well, that was the 18th of the 6th, the last set of results they had. That was Indices thing. So even the brokers got 20% upside. When you know a broker has just 20% upside, you think, You very rarely see a broker target that's literally, oh, these have rallied so strongly now, they're going to come back. They'll always be positive. And that's why I don't trust them at all, because they'll never say, oh, this should be valued down below this share price, really. It's got a height of itself. So that's why I never touch broker share prices targets. Anyway, okay. November, is it? November 19th. Okay, I'll put that in there. That's good. I'll look for that. But yeah, that's what I'm saying. Sometimes it's hard to keep up with like 70 odd companies. If we can get down to 50, I can manage them. But when you have 50 companies, there's a bit of quality there. Amongst them, there's quality, not just quantity. So that's why I want to do this, on a webinar on a weekly basis, go through these companies and say, okay, watch, legal, ignore. No, that's last week's. I'm updating that. I haven't done it yet. Okay. We did do this last week, right? Personal group. But they did come out with results. I don't know why I did this. I think so every day on the website, as you probably know, if you click on news, you only get news from companies sub 100 million market cap with revenue, right? And I often come across companies that think, I've never even heard of them. So what you do then is add them on here on Investigate. You can literally, type in a company, well, IGP, for example. You've got to log in, of course. And then you can add into a list. So every company I don't see or I'm not aware of that's sub 100 million and got revenue, I'll add to my list. So now I got a huge amount of companies there, but so I get emails. So I do check them every day. So I'm probably following now, but I think about 400 companies. Most of them are crap, but nevertheless. But like I said, scroll on there and look at that, for example. It's got a little bit of revenue, but yeah. So it's worth checking those out. If you see any companies on there, so all we need, right? I mean, I'm always up for adding companies of quality. So these are the filters. If you find any companies that are sub 100 million market cap, why? Because 60% of winners over 3 to 5 years, the best winners, come from that area, and they've got profitable and hopefully broker targets. I mean, if they're profitable, they will have broker targets. It's only some of the really bad companies who don't have brokers covering them. Yeah, and so I go through all these every day and add them to my list whenever I think there's a company in there worth looking at. So it's amazing how many companies you look at and think I've never heard of those. Anyway, yeah, like I said, I did put that on last week, but they came up with results this week, final results, I think it was, or maybe interim, was it? PGH. So we'll look at them and see whether they should be struck off the list or not. Interim results it was. So we'll have a look at personal group because I think I do this podcast every day now. I don't know if you listen to it, but I basically look at results of companies, microcap companies, and I look at revenue, profit or loss before tax, and cash, and see if those three metrics improving. And I think this company did. So let's have a look. And I thought, oh, that's interesting. So let's have a look at it. Where are you? Personal group. Here we are. So remember, everything in the red has just been updated. Sorry, everything in the blue has had results in the last 7 days, or I've updated it in the last 7 days. Everything in red is coming up. Where's personal group? There we are. So they are number 35. Okay. So I will monitor lots of companies. Don't worry about, this list I want to see is a list of high quality companies. I will monitor, most companies that are 100 million on a daily basis. And then, if they're good, they're growing, we'll add them. So don't worry about taking them off the list. But what I want is a condensed, list of companies, MicroCap League, where we know they're good quality, and the probability of you making money are higher on them. So not speculative stuff, but anyway. Here we go. Personal group. What do? They are a workforce benefits and services provider. Now, I don't know many companies do that. The group enables employers across the UK to improve employee engagement and support their people's physical, mental, social, and financial well-being. Its vision is to create a brighter future for the UK workforce. Heal the world. Make this a better place. But that's the theme tune. Anyway, so that's what they do. They do insurance and member benefits. Share price 167. Target price 210. 25% upside. Market cap 51 million. Enterprise value 34. So we know they've got more cash than debt. That's a good sign. Average daily volume isn't huge. 40 grand. Revenue 49 million. What's the market cap? Yeah. They've been operating loss profit last year of 4.6. Remember, these are full year results, okay? So they've got cash, decent amount of cash. I'm always interested a little bit when I see a company with a lot of cash and no debt. Okay, because that's a level of safety there, isn't it? So they are cash flow positive. Look at the dividend yield, 7.3%. Yes, it's attractive, but you shouldn't just go into a company for dividend yield. If you want dividend yields, buy a dividend fund or a bigger company. We want growth, capital upside. So that was last year's. So this year, you see here, this is what we're looking at. 30th of the 6th. Now, the top line is better. Net profit growth is better. Oh, no, 160% last year. So it's called 9 here, 18 last year. Okay, let's look at the value. PE of 14 is fine. EBITDA is 5. That's low because they've got a lot of cash and the EV is low. But you often think that, in this environment, it's not bad having a healthy level of cash because you can get some good, interest off it. But they've got to start employing that, investing that when interest rates go down somewhere because that's good. So it's gone up. The cash from last year, for the first half, has gone up to 20.6. What's the market cap? 51. So they're healthy. They're efficient, 40% margin. In fact, they don't have gross margins, but I put 40% in there because they've got a return on capital of 30.24 and 10. So it's all looking good there. Now let's look at the forecast, the potential. So they're saying that revenue is going to go down by 12%, but profit before tax is going to go up 38%. The PE of 9. Let's look at the chart. PGH. So, look at that. It's come down a long way. It's having these. That's 21%. That's where the brokers they're going. So first thing to look at, they're trying to get above that 200-day moving average, aren't they? And they seem to have hit a low down here. And you normally get sort of, big sell off of that, a real big V-shaped reaction sometimes, an oversold position, but then it comes back. And you've got a series of higher lows, lower highs, sorry. Let's draw some lines there. Some lower highs there. But you have got some higher lows, which is quite good. So you wanted to break out of there and go higher. I don't know what's happened, why it's come down so much. The broker's target is only 20% up. Anyway, PGH, ladies and gentlemen, shall we keep it on the MicroCap League? What do you think? What's your thoughts? Now we have to try and be disciplined here. Because if we don't just keep companies because they got a lot of cash and they pay a nice dividend, it's not what we're after, is it? We're after growth, but they are growing their things. What do you think? What's your thoughts? Yay or nay? PGH. What are you saying? Worth keeping an eye on. Divvy not to be sniffed at whilst we wait, says Ed. Yes. Adrian says, keep it. Okay. Keep for now. Alan says, yeah, PGH. Yes, keep. Looks like excellent value. Daniel, nah. Remove PGH. Better targets to go at. Yeah. So I say. That's a tricky one, isn't it? It's good value. Rob says good value. Okay, let's keep PGH. I think there's worse companies out there. Like I said, if you're looking at returning your money, Mick says keep, and you're going to get 7% there. And you could say, I mean, is it going to come back down here? I mean, do you know what's a good thing? I've been doing this rule about, I did say a week, but I'm going to do a month now. For the MicroCap League, if a company goes in the top 10, then if they have results out, I'm going to wait a month until I invest in it. And it's amazing how many stocks come back after the pump in full year results come out and come back down. But yes, they had half year results, which did gap up. And then you got some volume in, it's come back down. So of course that upside could grow a bit. And I think, well, you're going to expect a 7% dividend there. So I think, yeah, I think we keep. I think there's worse companies out there than. Do we know when next trading update is? Yeah. Well, they just had interim, so it's not going to be for a while now. But like I said, that's what the companies. So the interim just came out just now. So I shouldn't think it's going to be for a while. So it's going to be 3 months maybe. But let's have a look. Should we? So trading updates on the 24th of July. So do you see what I'm saying? This is how many. This is different. This is not the half year is not till 30th of June. So it's up to oh no, is it? Yeah, 30th of June. So the trade update there, AGM statement on the 2nd of May. So if you understand that's what May, June. It's almost 2 months before the trading statement. So that's why you can see sometimes. But yeah, so the next wait. We are August interim results there, September. It's not going to be for a while. So a trading update in January. Well, it's not that far off, is it? And you can monitor it, So January there, and then in March was the thing. So a couple of months before they do a trading update. So January. So I think they're not a bad business. They're not. I think there's chance of getting a return on your money there, isn't there? Wasn't Winkworth moved because it can't scale? Yeah, I don't know if I can put Winkworth back on, and I'm happy to put Winkworth back on. It was, small real estate. It may get bought out, Winkworth, but yeah. But let's put Winkworth back on then and reevaluate. I don't mind that. If it's in the top 50, keep. Similar valuation dividend. Oh, in fact, it's in the top 50. Was it? Oh, I like that little rule. I think we should be more skeptical on companies that are not in the top 50. It is. It's 35. Maybe that's a good rule. Yeah. I haven't seen the Beaks because the Beaks is value. It's not in the top 50, I think. Is it? Where's Beaks? Oh, no, it is. It's 36. Beaks. Yeah. But of course, they'll improve next year because their potential is still big. Okay. Yes, that's good. I quite like that. We're looking for top 50, right? Nifty 50. If they're not in the top 50, let's be a bit cynical about it, right? Let's take a while. So, we'll keep PGH, okay? I mean, we've got till January. I'll put a couple of lines in it. Like I said, I have put a sort of alert there, and maybe alert down here so it's low here because they've got 20 million of cash. If they get down to this level and they've got 20 million of cash and they're profitable, I think, hang on, that's cheap, isn't it? And sometimes you can just get, and you're picking up a dividend. PGH, recent low. So probably alert there on that level. And they get down there and think, that's interesting. Just keep an eye on them. They're going to rally and stuff. Anyway, so that's PGH. Okay. So we'll keep those. Next, Oxford Metrics. Oh, this is my board company. I thought, oh, they're cheap now. They got like 15 million of cash. But look at this now. This is when you've got to be a bit ruthless, I think. So let's have a look where they are. Rank. Yeah, they are rank at the moment. I didn't believe them though. I didn't even enjoy. I watched the entire presentation, the Capital Markets Day, and I didn't want the CEO, the lady. I didn't want her. And then I thought their orders were down, but whenever a company says that, but now they're not looking at orders and all that stuff. It's different kind of. They're looking at different things. Look at the potential here. So I've updated their broker note on the thing. So look at this. They are share price 59 pence, target price 110 still. Why are you believing that? See? Upside 84, 86%. When, though? They say 12 months. But net asset value per share, 62 pence, right? So look at this. The enterprise value is 13 million. That's nuts, isn't it? Market cap 7 because they've got 65 million in cash. They've got to start investing in companies, but the end markets are a bit, worrying really. But anyway, so like I said, these are half-year results compared to last year's. They were already weak. I don't know why. See, looking at it now, it's the plain cold light of day. It's obvious. But I just looked at the chart. They always bounce off this, but not when they come up with the bad trading. Look at this now. They go whoop, 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 and look. Uh-oh, that's the worry about buying weakness. You're better off buying up here. You know it's going in the right direction. There we go. So look at the potential here now. Look at this. This has lately been updated. Forecast profit for growth, minus 52%. Forecast PE, they're going to be 31. So you have to understand that they're not going to be cheap on a PE level. That's valuing their market cap, of course, to their earnings. Because the market cap is still 70, is it? 77. And these are the forecasts now, profit for next year. Going down from 6.2 to 3 million. Mm. Anyway, OMG, it's a good little they got Oxford in the title. They do technical stuff. It's worth looking at. They're doing this markerless sort of, they do for film and TV and all that stuff. They put these these sort of what is it, computerized generated things for games, gaming's having a hard time as well. And all that stuff. So they do that. They do markerless. They work for companies that are winning Oscars and Emmys. Markerless. So now they can map out. People before used to have to put these little things, markers on them, and stand in these suits, and then they used to jump them and they move around. And they create then a digital image of that and overlay. Now they've got this tech. Now they don't need markers on you. They can just look at your body, your AI, and all that stuff. But I just think the end market, the brokers are bastards. You read the broker target. They're going for 15% profit before tax margins. They let it grow by a certain amount. It looks nailed on, they said. Yeah, really? No, it's not nailed on at all. Nothing's nailed on. But anyway, Oxford metrics. Now, even with that cash, they're looking like, what do you think? OMG? Oh my God, more like. Yeah. Should we keep or knock them off for now? I've often started M&A in the sector is very difficult because competition add-ons are privately owned and fully priced. So just deposit cash accounts to remove. Alan says, yeah, doesn't add up. Remove, Pete says. Is that tangible net asset value? I think it's just net assets. So that is Daniel. OMG, their customers will not update their equipment in this macro environment. They'll hold off, so sales will be weak. Yeah, not off. And there will be a time, but not soon, that OMG may be a good buy, So I tell you what, though, if they get down to sort of a valuation of, below cash level, they're not far off that, are they? They've got cash of 60 million. They're valued at 77. So the entire technology there is valued at 17 million, pretty much. Good recovery, yes. Recoveries are hard though, and like I said, they could have another profit one after this, Rob. So I think we wait until recoveries came close because even with recoveries, people tend not to believe it straight away. So yeah, it's why I'll put a chart alert to it, but I don't think it should be in the top. I don't think it should be in the thing. I think as yet, it's distracting. That's what I think. A distraction when there are other better plays out there. I think they could bounce. I do think it could bounce, and maybe it is starting to bounce. But I mean, like I said, if it gets down to where are they? They got 65 million worth of cash, and their market cap is 77. They got a bit of debt. It is one of those things, isn't it? As a value play, not a growth play. Be thinking, how cheap can they get now? if they're still turning a profit, right? If they even do like 3 million of profit or 2.5 million of profit, they're still profitable. It's a, see, this is why I like my investment. They're still profitable. If you're a value investor now, you'd say, hang on a sec, they're not be, that cash is not be going away. They're earning 5% on that cash, pretty much 4%, whatever they're earning on it, and they're going to be earning. Well, in fact, that figure there includes their cash. But you know what I'm saying? They're like 77 million, and now they've got cash 65. Thinking, how low can they go? They're going to cut that dividend, surely. And there's a dividend, wasn't it, in that? Yeah, the dividend is 4.65. Having said that, would they? They got a lot of cash. Why would they cut the dividend? So I see this as a play, especially now. I don't know. Where are they? They are 49. Oh, they don't score well in momentum, health, efficiency, in fact, value. Yeah. Uh, it's an interesting one, isn't it? What do you reckon? What do you reckon? They they don't do anything with that cash, do they? Off until they invest, yeah. Yeah, they had an M&A pipeline as well. They keep saying that, yeah. Maybe this will kick up the arse now. They need to do something. They need to buy some growth. They got a lot of cash. Buy a company growing very quickly with the best tech. You've got plenty of cash to do it. And I don't know how long the CEO's been there, a couple of years, Just get on with it. Get on with it. There are 49. Uh, I think they're interesting, well, there are companies out there. I don't see the point of this. There's low margin, and I can see getting rid of those, and they're not really churning out. They got a tiny bit of sort of profit. I can see the reason why we should get rid of those. But maybe we should hang on to the price. Space and People. Okay, that surprised me. This at the top. This did drop once I put in the forecast, but it's because of the size of the market cap. Space and People. They are eighth. Okay. And we all know what they do. They, basically lease off what the big sort of, shopping centers and all that stuff that own this, space in between the shops or outside for events or in train stations, all that stuff with promotions. They lease that off the owners of that, and then they charge sort of brands and all that stuff to use that space. It's a tiny market cap, so the broker target got 220, 150 upside. Market cap 1.6, enterprise value 960. This with these finally, these are half year results. Okay, like I said, the volume here is 6,000. So if you take a big size in this, you're going to find it hard to get out. Probably tanking the share price. But revenue is 5.8. Operating profit last year 239 grand. They've got a bit of debt. That's the C-bills debt, I think, isn't it? No dividend. So next year's their results. So these are half-year results. So they are growing, but top line operating cash flow has gone down 6%. It's fine, 11% there. The value is okay. In fact, they didn't earn a profit on a net basis here, but they are price to book. Oh, okay. So they got net debt of. In fact, that's gone. They did have net cash last year, but now it's gone net debt. Yeah. Gross margin is good. Obviously, they're not making money on operating and margin. But if you've got potential here, so revenue growth of that, 11%, forecast profit growth of 79%, and PE of 9 next year, I reckon. This is one of the kind I do question. I understand it's small, and they may just rally because it's so small, and you're thinking they're doing like 6 million in revenue. They get a bit of margin on that, maybe it'll help. So let's look at the forecast. So yeah, 6,572,8. It's about the consumer, isn't it, really? This kind of company, or is the contracts they have, I suppose. But like I said, if they get the profitability, it's not a huge profit. That's the problem. I know they're in a small market cap, but it's one of those companies I think, can it scale? In fact, I owned these a while back. I did question that then. Can they scale? I don't know. So that's the only problem. The trouble is here on the broker forecast, all I had was the first year. So that's what the first year is. So I just replicated the margins. The margins may improve, you know. But if you replicate the margins and the margins are going to improve, then at least you're being conservative. You don't want to overextend that. But let's have a look at Space and People. It's rallied quite a bit recently, just because I think it went down to like 1 million, did it? Something ridiculous. So from the lows, let's see, COVID was a thing, 55 pence, so 1.8, so almost doubled there. But it's come off from these results a little bit, back to 88 pence. But Space and People, ladies and gentlemen, do we give it space on the MicroCap League? Can it scale? Let me know. What's your thoughts? Oh, where are we? Oh, sorry. Thanks. Oh, top 50, OMG, sorry. Well, potential naught. What is it? Remove. Yeah, Alan says remove potential. Yes, I think you're right, Alan. I think maybe get OMG off. The thing is, there's several different ways to score a goal, isn't there? Now, if we are looking at companies that have growth and value, OMG should be in there. But part of me thinks that could have a nice bounce if they come up with it, but not yet. I mean, we know now they've done a pre-trading update that's bad. Now, when the actual interims come out, it's going to still be bad. So there's plenty of time, I mean, so I think we remove actually. Okay, Pete, Space and People too small to make a play on this one without getting yourself trapped when you might need to sell. I'd remove. Agreed, Pete and Jam tomorrow business. Yeah. Pete and Jam tomorrow business. So agreed, Pete. Jam tomorrow business. Yeah. Too small, says Tim. No, says Mark. David, keep Q4 strong and they're recruited over the summer. Yeah, but how? I know. I think do you hold some, David? Yeah, I know what I mean. It may rally, but if we're looking at this at the top of the league, though, isn't it? But can it scale? So are they always going to be earning 180 grand? 180 grand is a listed company. There are people who earn that, in wages. They're not listed, just private people. Too small. David says keep. Move them out. More space for B. Haven't you had space? Yeah, I did. I just like. Did I own over 3% of it? Did I? I think. Then I realised can't really scale, can they? So I just like the value of it. And the growth is not that big. They can't really scale, can they? So I think it'll have little pops and drops, but it's not the type of business I don't think that would,
Justin,
really scale. Go on,
Justin,
David. Tell me
here we
what
go
you're
again. Here we go again. Sure, I see what you mean about the forecast, the 24 forecast, 200K. Are they going to beat it? Who knows? I personally think they are with a 6 million revenue business. They're expanding into Europe, which is something they haven't done before. They're in a new macro environment, right? No one's going into shops, no one's renting shops. They're all doing these small startup activations. So I think you'll get some revisions. For my view, I'd say keep it on the watch list until you get the next trading update. Because there was nothing to scare people off on that one. I agree it's a 1.7 million, 1.8 million business valuation. But that could boom very quickly. Just look at what's happened to a few of the other micro cap ones recently.
Yeah. Well, it's unusual to see a company that size making any profit. So if it does make profit, then I suppose you could say, look at that, it's growing and it's making a profit, which is more than compared to other companies. So okay, all right, Dave. Well, you come on. We'll keep it on for a while then. Okay, but I think we'll move OMG because it's not growth, it's not growing, it's not got any value now, and the forecasts are dreadful. So okay, all right. Yeah. So if you want to go for OMG, I remember one of the guys in the weekend podcast at Space and People. You misheard him and said it was. You said you thought it was Asian people. I was having a pint at the time. Laughed and it landed on my wife's blouse. Yeah, it would be funny if someone was having an Asian, a stock called Asian people. What? Release the sausages. Yeah, that's what. Yeah, no, I thought you said Asian. I hold stock in Asian people. Well, that sounds quite good. That company. It's just okay. Yeah, that's what Keir Starmer says, isn't it? Release the sausages. Do you see the Conservative Party Twitter account retweeting that? And making fun of it. That the Conservatives, first of all, sack your social media manager. You should be focusing on more important things than that. Leave the jokes to other people on Twitter. You are, you are. I mean, they are the second biggest, aren't they? Time Finance. I don't think any question about this. Now look at this, right? What people don't understand, I think, about Time Finance is that they have a risk, procedure where where they literally, will not go too risky on loans. If they do, they can broker that out. They get a fee off that. Okay. Now, what's valuable for them is lending off their own book, because they not only get arrangement fee, they also get interest, and that compounds. And the longer the loan is, the more the interest compounds. And so that's what they're doing. That was one of the goals they had, was to increase their loan book. I mean, they did two things today, right? They released full year results. Remember, not timeout. Remember, full year results or interim results can be a liquidity event for people who've held for a while. So you're not often getting a true reflection of what the results are, on the day, especially if they've risen like 8% before. So you often don't worry about, the share price on the day. If it drops by 30%, fair enough. You could say that's a judgment on the results. But if you're talking about 2 or 3% drop when you think it should have gone up, don't worry too much about it, because it's just volume, and you have more volume on a results day than you'll ever. So, but they did two things today. Final results. Now look at this. Look at it. All double digits. Top four tax, 41%. Own book lending up 25%. That's where the good money is. Lending book, 18%. There's nothing there, is it? It's not good. And then they came out with Q1, the new year. And look at this. More of the same. Own book lending up 9%. Remember, revenue 20%. Profit before tax 46% again, compared to previously. 14, 17. It's like, what? It's a great little business, it really is. And it's dipped down, I think, because so if you look at the potential here, and I think it's also about quality of earnings, visibility. So the brokers have upgraded to 112. So 100, I agree with that one, because I hold. But so we're looking at the results here. Okay, the cash flow's gone down a bit. The debt of that, the cash is fine, but they're profitable. Doesn't matter. So going forward, okay, the value, there's still a PE of 11 on that type of growth. Look at that, 21% top line, 39% operating profit, 29% net profit growth, and there's still only a PE of 11. Right? Now, look forward a little bit. Okay, a little bit of growth here. That's the problem. Their value is good. But if you scroll forward a bit more, of course, forecasts are less predictable. So top line growth isn't going to be huge, but their margins, because there's compound growth now, improve massively. I mean, look at that pre-tax profit growth. It's got 24% there in the year after. And if you look at the PE on that, it starts coming down again to like 8, 7. So it's never going to stay around where it is, I don't think. It's one of those companies, and they keep up, overperforming, excelling, exceeding on a regular basis. It's one of those companies where you think, oh, they're going to continue to do well, aren't they? Because they know they know what they're doing. If you watch Investor Meet, they've got a very strict criteria of lending, and the market's hard. So, banks now don't ever lend to small and medium-sized enterprises. So, if you're a good company, you can do that, and flexibility, you'll do well. So, I'm not too concerned about time file. So anyway, like I said, it is, where is it? It is number 18. There we are. It's a good. Any questions about that? Anything else? Oh yeah, two more. Transense Technologies. Now this is an example. We covered these a while back, and they came up with great results. I didn't really believe it because the margins were very good. I thought, really, it's a very small business. I didn't really understand it, but they came up with good results here. But they've also come back a bit. But at the time, they were rallying like crazy. It's almost like, wait a month. These are final results, by the way. So they are a developer, a specialist sensor technology and measurement systems. The company has 2 active businesses, Translogic, a range of smart connected tire inspection and management equipment, and used by SAL, developing surface acoustic wave for sensor technology. Anyway, so they are market cap 25, enterprise value 23. So okay. What's the target price here? Again, they've rallied a lot. So when the broker target's like 20%, even the broker thinking, operating profit there is good, all green on the screen, cash, yet no debt. So 80% top line. Look at that, operating profit up 65%, net profit of 12, operating cash flow is all good. But the value now is a little bit, it's getting up there. Price of sale 6. What's the P? 16. It's not too bad if you're growing, double digit. Good health, the efficiency, like this. Operating margin almost 30. Return on capital 21, double what's it's needed to get in the green there, score top marks. But look at this, look at the forecast. So even though it's risen a lot, the forecasts are looking good. Now remember, these are full year results, so we are looking ahead to the next year. So maybe we're early a little bit on this, but nevertheless, they're showing this is going to be moved up, by the way. Forecasts are going to be moved up above the figures, so you can have forecast, directly below that. The figures will drop down. I've asked the developer to do that. So they're looking at 1.6, 0.9. Again, it's quite a small business, but I'm thinking to this kind of margins. That shows why there's, price of sales is quite high because the margins are, are good. Almost 37%. What? I didn't almost believe that. So I'm saying keep an eye on this TRT, and I know someone, one of the members told me about this a few days back, I think, before results come out. Keep an eye on these. But again, great results, but it's rallied a bit. It's coming down. So I'm going to let that settle for a while. It is now, it's maybe going to be part of my MicroCap League fund, but I'm going to wait for it to touch this 50-day moving average, I think, or give it a month. I'll give it a month, see where it goes. So give it a month after results, and then if they get anything come out, then I maybe add it to my little investment thing. So anyone else on Transense? You like the Transense, but it's a good little company. What was your take on Trufin results? Lost Lloyd's, but gaming going very well. Yeah, no, very good. Trufin, PlayStack knocking out of the park, I thought. But I suppose it depends how many hits they have on that. That's what I'm saying. It's less visibility on those kind of, on the gaming side, isn't there? So they're doing very well. Out of all the gaming companies, they're probably doing the best. In my mind, now that uncertainty about Lloyd's, you can't replace Lloyd's. They're a huge, business. So I'm a little bit confused as to where they go. I mean, how long that profitability will continue. We'll see. For the full year, by the way, they aren't expected to be profitable. So we'll see. But apparently they got enough cash to get to, full year profitability. So worth a watch. If they do that, then they'll be added. But I think now it's just that worrying thing is why have Lloyd's? I mean, it can be completely unrelated to Stargo. It can be Lloyd's just changing management. These big companies have these managers come in. What we spend on there? Cut that down. We don't need that. We'll do this. So it can just be an internal audit by Lloyd's. But it's just that was a huge future revenue potential, earnings potential Lloyd's. And so hopefully they can build up more customers. But I do like that tech. I'm just going to watch it for a while. It's just uncertainty, isn't it? And in this market, it's not going to go nuts overnight. And lastly, water intelligence. Yes, I've got some intelligent water. So I'm going to keep Transense because I like it. But water intelligence, where are they? They are, by the way, if you look at water intelligence numbers, thinking these don't add up. That's because they're in pounds on this website, because that way you can work out the PE properly, but they report in dollars, and the exchange rate is 0.75, I think it is. But they are a multinational provider of precision, minimally invasive leak detection. So it's a big thing, water detection, I think. But target price 101. Target price is £8, and they're 398. 77 million enterprise value. So they got a bit of debt there. Was debt 15 million? These were half-year results, by the way. So we look at this side, and these don't forecast into the scores. I do score them here, but they don't feature in the the MicroCap League scores, but the potential does for the full year. So when you see this now, before the half-year results didn't have any play really in the full results. Now they do because like I said, halfway through a year, how well a company's going. So revenue was 7%, pretty much the same as last year. Operating profit up 10%. So it's improving that, isn't it? Net profit growth 26% last year, 11%. Cash flow has improved. Value of P 14. EBITDA 8 is fine. They got net debt of 10 mil. There. But they're generating cash, but the efficiency is good. 87% gross, operating margins 12, return on capital is good. So if they're doing, I suppose they if you're doing like 5 million, that's fine. That debt's not even a worry, is it really? Again, they reckon next year top line grows around about the same 6-7%, but profit before tax is going to grow, and PE will be 13. So the profit's going to grow. In fact, it's all going to grow, but the top line again will be stable, but the margins are improving. Let's look at the chart here. WATR. That's what I see. You get to the stage where you invest in the top 10 of any companies, and it looks fine. What's to worry about? They're looking good in every metric. You can just sometimes you can buy 10 of them. You don't know which one's going to rise the most because that's the luck of the market, supply and demand of stock. But there we are. We're in a bit of a range here. It's come from, because it's come down, and the low of 13, 18 there, and it's struggling to get above this, like I say, they have come up recently to about 433, but recently it's having a little burst downwards there. So it's not convincingly breaking out, is it? It's in this range. What do you think of water technology? Anyone? Everyone? Anyone? Everyone? WATR. What do you think? Transense fully valued. Water not going to blow your socks off. No. No. I wouldn't want water to blow my socks off. I remember looking at water intelligence when you had the daily chats with John and Fox. I like them. Keep them on. I have a few of these. Just small holding though. Okay. They have a bit of competition, but still good company. Mark, no. Okay, it's fine. Anyone else on water? Water, take it or leave it. Not good enough growth. Yeah. Remember, yeah. Remember, revenue, right, is validation of the product selling, the services selling. Okay. That on its own, though, is just vanity. Like I said, revenue growth is vanity, profit sanity. If you get that both, and you keep those margins, and you've got the revenue growth, that shows people want your service or your product. And if you keep the margins, you're not marketing highly to get those sales, you're still getting the profit. So yeah, I mean, it's a little bit concerning that the top line is not that impressive, but their margins are improving. If they do that and they continue to put on the cash, then they'll be fine. Aren't these priced in dollars? Not yes, they're priced in dollars. That's another thing actually. So yeah, so on the website here you'll see pounds. I've converted them over to pounds, so it'll match up with the PE with the market cap. But the dollar's getting weaker, isn't it? I think most of their business in the US. So if the dollar's getting weaker, that means they have to convert to pounds or whatever. Yeah, do they convert to pounds or they just keep it in? I don't know. Anyway, so maybe that's not a good thing for them. They have business in the UK too, do they? Okay, all right. But what do you think? Mick says yes. Anyone else? Is anyone else feeling strongly about them coming off? I mean, as yet, I don't think get them off because they are profit generating and they may break up. And do you know what the thing is with this? When they do rally, they do rally. I mean, look at this. And for some reason, I don't know why there's a rally so hard here. But you got this range here, and they went from 3 quid to 13 quid. Sometimes that can happen. That this latent sort of it'll take a while to come down and bend round, but you find it may not as high as that again. But you do tend to find when companies start to rally, when it starts to rally, people look back at it and think, oh, and start piling in. Less sophisticated investors would think, oh, it's done that before, it'll do it again. And that generates the hope high potential. So maybe it will rally way above. I remember when it was high, I thought, the valuation is very overvalued that. But now it's not so much. It's it's fine. So it's up to you. What do you think? Water, yes, I hold. Will need leak detection after World War III started. Yes, exactly. Called global water conservation. I think it wound up. Oh, okay. Well, if no one's feeling strongly, let's leave it on. A couple of you hold it. Let's leave it on. OMG's off. That's fine. That's, getting one off today, and that's it. Thank you very much, everyone. And keep an eye on this forecast. Okay, if the company's doing well, then you want to keep doing well. That's sustainable growth. So keep an eye on those. But I'm really happy with how this turned out, and the scoring system now is looking good. Really looking good. I mean, let's be honest. For a long time, Journeo, what is it? Synectics, they've all been at the top. In fact, Vincent was at the top for a while, riding like crazy. I didn't believe it. I should believe the figures sometimes. Just believe the figures rather than gut sometimes. Thank you very much, everyone. Speak to you next weeky, and should be ready to go for my tea now. Speak soon. If I buy or sell anything, I'll update. Bye 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 bye.